opportunity of delivering welcoming address and opening remarks. So I would like to thank ASSOCHAM for giving me this opportunity. So it's a great pleasure to welcome you all. Our session chairman, Dr. Surjit Bhalla, former Executive Director, India International Monetary Fund. Sir, I welcome you. You are a great speaker and your knowledge is excellent. We are expecting good insights from you. Our other panelists are Upasana Bhardwaj, who is Chief Economist, Kotak Mahindra Bank, Sri Indranil Sen Gupta, Head of Research, CLSA India, Sri Abhik Barua, Chief Economics and Executive Vice President, HDFC Bank, Sri Siddharth Sanyal, Chief Economist and Head of Research, Bandhan Bank, Sri Arjun G. Nagarajan, Chief Economist and Communication Manager, Sundaram Asset Management Company Limited, and Dr. Charan Singh, Committee Member, ASSOCHAM National Council for Banking and Chief Executive, EGROW Foundation, and also Sri Basudev Mukherjee, Assistant Secretary General, ASSOCHAM. Sir, on behalf of ASSOCHAM and EGROW Foundation, welcome you all the speakers and all the audience who are there today with us. So we are discussing on monetary policy, forthcoming monetary policy by RBI on 6th April. There is a great challenges this time from RBI. Fed has already increased 25 basis point. What RBI will do, it depends on many factors, domestic as well as global. Domestic, I can say, just hold on. सुमन, मैं बाद में बात करता हूँ मीटिंग में. So I was saying that it's a great challenge by the RBI that what to do, because as per Reuters survey of economists of around 55 members, they have conducted the survey, and out of 55, 34 economists has suggested 25 basis increase, and rest said that pose no increase. Considering January inflation was 6.52%, February inflation was 6.44%. Moreover, core inflation is sticky around 6%. So we are expecting that RBI can increase 25 basis points. And moreover, we have seen that during the calendar year 22, 10 months inflation remained more than 6%. That is upper tolerance limit of 6%. So, and also this quarter RBI was expecting that inflation should be around 5.7%, whereas it is considering that in January and February it is over 6%. We are hopeful that it should remain around 6%. So, so that pressure is also there. Moreover, as I said, that US Fed has increased, Bank of England or European Bank, all are increasing following hawkish instance, and monetary policy which has to be considered international factor, because they have to consider that flow, and in that fund should not go outside. So considering that, more likely is that 25 basis should be increased, and I would like to listen the views of all other friends or panelists who are sitting. So thank you very much, and once again welcome you all to all the panel speakers as well as this audience. Thanks to all.
Dr. Rajesh.
Yes, sir.
from SHM after this. Anybody else would like to speak, or we take over and then we bring in Mr. Sadaf Sayed towards the end? What do you prefer?
No, sir, I think I request you कि we should go for as per the agenda.
Okay, I'll go with the agenda. So let me then welcome all of you to our shadow monetary policy, which EGROW is doing along with the Trade Association ASSOCHAM, and we have been doing it for a number of years now. And today is, I think, a very crucial time in the monetary policy junction in recent times. Dr. Surjit Bhalla has joined, but he will come in a little late. So I am just chairing it until he takes over. I would like to mention that in recent weeks, after our last shadow monetary policy and our last monetary policy by the RBI, much has happened. We have all seen what has happened to the Silicon Valley Bank, and after the Silicon Valley Bank, the that happened there workplace, and then the takeover of the Silicon Valley Bank. That has all happened in the last 3-4 weeks. That has changed the scenario. The interest rate cycle that was reasonably aggressive in Euro and America suddenly seems to have lost the wind. And we have seen that America, the Fed Reserve, just raised the rate by 25 basis points. There was a discussion, would they raise it or not even raise it? But they have raised it. Euro area also, Madame Lagarde in her argument, they have also raised the rate. UK has also raised the rates, as well as one thing to notice, Brazil and Russia have not raised the rates. Now is the time for India to consider it wants to do so or not. My views are that the economy, our economy, is doing very well. It's going to be the fastest growing economy in the world. In next 10 days, we will have the latest growth estimates from the IMF and the World Bank, which are very respectable. We need to wait. But given the trend they are right now, as far as agriculture is concerned, the worry is this year there may be El Nino, and therefore one has to be a little cautious. It could mean a weaker monsoon. As far as industry is concerned, so far the index, IIP index, is doing well in terms of both mining around 5.8% growth so far, manufacturing is around 4.8, electricity is around 10.1, and general, of course, in aggregate is around 5.4. If you look at the core industries, the 8 core industries, the production of fertilizers, electricity, steel, natural gas, cement, and refinery products increased in January over the corresponding period of the last year. So industry is doing well as of now. If we look at the PMI, the Purchasing Managers Index in manufacturing, in February it is around 55.3, which is slightly better than in January, but long run average is around 53.7. So we are certainly doing much better on PMI. Growth in straight 20 months. If we look at PMI in services, we are around 59.4% in February, 57.2 in January, and business activity index is the highest in 12 years. So output in February is around 59, the PMI, and it is higher than 57.5 in January. So the industry is doing reasonably well. Look at the high frequency data, the bike sales, TVS Motor Company and Hero Motor Company, as sale of chips and availability of chips has eased, they're beating their old records. Three-wheeler segment, same story of success. Look at the sales in February and March was expected to be better. The figures have yet not come in. The two-wheelers have increased by 15%, three-wheelers by 81%, passenger vehicles by 11%, tractors by 14%, and commercial vehicles by 17%. So the economy is doing pretty good. As far as fiscal is concerned, GST collections continue to be very high. Rupees 1.5 lakh crore in February, For 12 months, it has been above 1.4 lakh crore. It's 12% higher than in February last year. And if you look at imports, higher by 6%. And if you look at domestic transactions, higher by 15%. GST collection, that means trade is doing well. Direct taxes, the corporate income tax collection is around 13.6%. That's March up till March 10 figure. And the personal income tax is higher by about 20.7%. So the tax collections are also going on well. The important thing for the rate is the consumer price index. Look at the latest data that's been released on 13th March on CPI. The CPI combined is around 6.4%, certainly slightly higher than the normal band, but the food CPI is around 5.95%. So I think that is coming within the range. Even January data was around 6.5 for overall CPI and 6 as far as food is concerned. So I think inflation to that extent is reasonably well under control. And that is one of the reasons that I feel, given the change in the interest rate cycle, given what has happened in the Silicon Valley Bank and the Fed Reserve and the Euro has taken caution, I think we need to be now a little careful in our interest rates. As far as aggregate deposits are concerned, the growth up to now is around 10.3% vis-a-vis 8.8% last year. And as far as credit growth is concerned, we are around 15.7% now and compared to 9.5% last year. Given the CPI, given the deposit growth, given the growth trend, I feel a time has come that we do a pause button on the interest rate cycle. So therefore, my recommendation would be things are in control, unnecessarily increasing without any evidence and reason now the interest rate cycle, given that internationally there is moderation, and given that within the country inflation is not very high, the RBI should consider pausing for some time. The last thing I want to mention is the EMIs on the housing. Now that is worrisome. With the inflation in moderation, if interest rates continue to rise, the EMIs increase. It has a dent on, and as you know, housing sector has a linkage with about 275 industries. If it has a dent on any of the industries, it would unnecessarily slow down growth and impact growth. So therefore, my recommendation is that we should now go for moderation and pause as far as the interest is concerned. With those initial remarks, I would now like to invite Indranil. Indranil he's the head of research at CLSA India. And after Indranil, we'll have Mr. Abhik Barua, who's the chief economist and executive vice president at HDFC, followed by Madam Upasana Bharadwaj, who's the chief economist at Kotak Mahindra Bank, then followed by Shri Siddharth Sanyal, chief economist and head of research at Bandhan Bank. We will then invite Dr. Surjit Bhalla to share his views, followed by Arjun Nagarajan, chief economist and communication manager, Sundaram Mutual, and then we will go to Muthoot CEO to tell us about the microfinance. With that, let me invite Mr. Indranil now.
Thank you, sir. Am I audible?
Yes, you are.
Okay. So we are looking at a 25 basis point hike by the RBI on April 6th and a 100 basis point cut beginning October. This presumes that inflation and growth both fall to around 5.5% in FY24. Now, obviously, the RBI's rate decisions are by and large at the hands of the Fed, given that the rupee is still relatively weak, and that you don't want to fritter away FX reserves if the FX market sells off. Now, looking at the Fed, our house view is that the Fed pauses at 5 quarter. That's another hike, and then cuts 50 basis points in the second half of 2024. Now, also think that in case there isn't really the sort of bank scare that currently is being thought about, the Fed may well hike further and very well go to 5.75 to 6%. In fact, if you see the dot plot, there were many people there who were willing to go that far, and then if that happens, then the RBI will similarly have to maybe go to 6 to 7% at least. So we have to wait and see what happens in the US and in Europe as far as banking systems and financial stability are concerned. Secondly, when we met earlier, inflation was coming off to the 5.5% levels, and that provided some buffer for the RBI domestically. Since then, inflation has surprised on the upside, and as you know, it's been about 6.3, 6.4 average between January to February. There could be some data issues, but even if you take those data issues out, inflation is not much less than 6.1, 6.2%. Core inflation, of course, is higher. If you take core, which I do, then that's close to 7%. So that, I think, provides an additional reason for the RBI to hike rates at this point in time. Of course, inflation should roll down from March onwards as the base effects kick in. But then, there are base effects that is going to pull down inflation. And, as Dr. Charan Singh said, that there is an El Nino on the horizon. So one doesn't quite know how much inflation will go down, because a 5% swing in food prices, as we all know, hits overall inflation by about 250 basis points. So looking ahead, I think the more the RBI hikes, the more it will cut. So if it stops at 6.75%, it can cut, maybe 100 basis points from October onwards. If it goes to 7, because the Fed again starts hiking, then maybe it cuts 125 basis points next year. Now, I do agree with Dr. Singh that because the RBI is raising, that is leading to higher EMIs, which is a dampener for growth. But I think the problem is that it is this linkage between the repo rate and the EBLR that is now resulting in a problem of the FX market going to the credit market. So I think that rather than give up on the currency, maybe we need to explore, ways and means to disassociate the two. Administered interest rates, in any case, are not a great idea. So obviously, this was done to bring down lending rates faster. Unfortunately, at that time, there weren't much more of RBI rate cuts, and now what is happening is the reverse. That the interest rates for the vulnerable sections have gone up much more than the overall interest rate. So if you see, MCLR has gone up 120 basis points, EBLR has gone up 250 basis points. If you see it in terms of real lending rates, real MCLR has actually gone up about 700 basis points. If you take core WPI, and real EBLR is up almost 800 basis points. So I think that there is a need to, protect the credit market from, what is essentially a FX market problem. And maybe, this could take many forms. It could take the form of, providing some subvention from the government on lending rates. It could take the form of maybe reducing CRR, and reducing the cost of raising deposits and hence lending rates. We need to, wait and watch. But bottom line, I think that right now we are looking at a 25 basis point hike on April 6th. So transfer to a week.
Yeah, thanks. Dr. Singh, would you like to come in, or should I just go ahead?
Please go ahead.
Yeah, no, I thank you very much, and I would broadly agree with Indranil on what he has been saying, including the kind of risks on the Fed side, towards the upside. He, alluded to the dot plot, where there are a number of Fed members who don't want to be spooked or taken influenced too much by the Silicon Valley Bank or the financial stability problem that had arisen. It has come under control. That being said, I somehow disagree with Dr. Singh's characterization that inflation is comfortable. It is certainly extremely elevated, and the difference between 5.95 and 6 is really very minor. And ultimately, if we were to follow the flexible income inflation targeting regime, are trying to get to, in the medium term, to a 4% number. The difference between 4% and the 6%, 6.4% is rather wide. And number two, I think one of the basic things, and I could be wrong on this, is that there is absolutely no free lunch in economics. And in order to get, and I mean, this is captured in the Phillips curve or what have you, that there is a trade-off between growth and inflation. And I think very strong growth numbers, along with elevated inflation numbers, particularly core inflation, which is in O'Neill referred to, which I think is the best measure of inflation, is actually a nightmare scenario for the RBI. I mean, you have to hurt something, and this has been highlighted and underlined by people like Larry Summers recently, that look, if you want to sort of bring growth inflation down in the US to an acceptable level, you will have to settle for a significantly higher unemployment rate than what prevails today. And he has, in a couple of his lectures, indicated what the unemployment rates should be. So let us not forget that there is a trade-off, and this notion that we can, achieve everything simultaneously.
Yeah, go ahead.
Is I think
Okay.
a little wishful.
Okay.
At the least, while I agree with Indranil on most things, I'm not too sure about the magnitude or the timing of the rate cuts when they will come, because if El Nino does pan out, etc., and with the numbers that the RBI itself has provided, I think it might err on the side of caution. Though technically, inflation might be below the target or the acceptable upper bound. And I again agree with Indranil that this brute force linking of certain rates with the benchmark rates has kind of led to some mispricing, which has affected the credit markets, and we've had very sort of unbalanced kind of movement in interest rates, and it perhaps should just be left. I think cutting CRR, etc., are difficult measures, especially when inflation is high. In fact, one would expect the RBI to perhaps squeeze liquidity further. But I think the issue that he has raised is a valid issue, and how we get past this without having to use more complex measures like subvention, etc., is really a challenge. But I think he has highlighted the problem very well. So both from the perspective of inflation control and from the perspective of maintaining an interest rate differential with the US, I would think that the RBI needs to hike by 25 basis points. And the rest of the hikes are contingent on what happens to domestic inflation and perhaps more so on what the Fed does. and that's sort of still open. I mean, there's nothing is done and dusted. And again, I mean, let me just emphasize, maybe my understanding of things is wrong, but there is a trade. We are consciously trying to slow growth down in order to get inflation under control. One can't, get away from that. That is unfortunately the nature of the beast. I'll just stop here. Thanks very much.
I just wanted to clarify, and we'll continue, but I don't want to come in the way of the flow of thought that is happening so beautiful. I had in mind that the oil prices have come down dramatically from the last time when we met. At that time, they were around $95 a barrel. They're around less than $80 a barrel now. The second point, which I missed in my presentation, and both you and Indranil brought it out so well, the inflation, despite such a stark, aggressive rate increase in all these countries, has hardly actually been brought to 2%. In America, it's still hovering around 5 to 6%. So my thought was, well, Russia-Ukraine war is a year back. Things would have moderated, but they haven't in the U.S. system. Larry Summers is right. There is a sacrifice ratio which is getting involved, but those countries can afford it because inflation is still 3 times their 30-year average. Honestly, inflation today around 6% in our country is around a 30-year average. So that was the 2 points that I missed in our argument, which I thought I'll just share at this point. But we will come around, and again, everybody will have a thought to share and dwell on some points. I'm sorry that I disrupted the flow of thought. Madam Upasana, can we continue with you?
Sure, Dr. Singh. I'd just like to pick up exactly from the point which Abhik ended with. I think most important aspect to keep in mind is that, we keep talking about how growth is expected to slow down, and as a result, we'll probably see the possibility of rate cuts happening. The central banks are engineering a slowdown. They want a slowdown to ensure that they can anchor inflation expectations. So this is a very different cycle that we're talking about as against the previous history, previous times when the policy response naturally was for a rate cut when they would see a global slowdown or a domestic slowdown. So in this case, to expect a quick shift from a rate hike cycle to a rate cutting cycle looks very difficult for me to believe. I think there will be a prolonged pause in between, and there will be adequate time given to assessing how the growth inflation dynamics is going to play out over a period of time. We are looking just similar to what Indranil and Abhik pointed out, similar factors really, high inflation, sticky core. We are looking at 25 basis of a repo rate hike. Of course, this was not our base case in the previous policy. I mean, we were expecting that by February we would end it at least and wait and watch how the situation is going to pan out. But after that, we've had 2 more inflation readings, whatever said and done, whatever the reasons are, but higher than 6%. RBI will not be in a position to ignore these 2 above 6% readings. And as a result, we are looking at 25 basis of a rate hike. After which, I think it's going to be more a wait and watch and not necessarily a done deal. A lot of factors will be crucial. We will be watching out for the monsoons, how things really pan out. And of course, how the Fed actions will be. Here, I'd just like to point out one aspect. The reason why in the last 2 weeks or so, we've seen a realignment of the Fed rate trajectory on the downside is largely because of the risk on the credit side, because of the banking crisis. Now, if the banking crisis contagion does not spill over, if it's well contained, then clearly the upside risk to the plus 25 basis that we're talking about, the Fed fund rate, will be higher. So at the moment, when we are looking at one more rate hike by the Fed also in the May policy, I would agree with Indranil when he says there is some upside to that 5-quarter on the Fed fund rate beyond May as well, as against what markets are pricing in. Markets actually have been pricing in till yesterday. It's very volatile now, but market pricing is suggesting a full-fledged cut from July. I think today it's shifted to September. So there is a realignment that is happening already, because as as of now, it appears that the banking crisis contagion has been contained. So if that is how it will pan out, then the chances of one more rate hike cannot be ruled out by the Fed. And at the same time, rate cutting cycle in the US also, I don't see that happen immediately. So like I said, it's a very exaggerated move that we expect, that rate hiking stops and we expect a rate cutting cycle. So I think there will be some amount of pause, some period of pause before we can start seeing. So even in the US, even though we are expecting recession to set in, probably from the September quarter, or maybe even June, July onwards, even then we don't expect a cut immediately. The Fed needs to be cautious and very convinced of a slide in the inflation numbers to really go ahead with cuts. So there will be a pause in between prolonged. Similarly, I expect for India as well. I do not see the possibility of a rate cut in the foreseeable future for India, more so because from a MPC's point of view, 4% is their medium-term target. While it provides comfort and flexibility to each of the members, if inflation remains below 6%, to stay on pause. But for a cut to happen, we need to be convincingly sure that we are going to be seeing or approaching 4% inflation. Now, reasons could be different. There is upside risk to monsoons. Core is extremely sticky. So, we'll have to see. And like, we know that India's growth is holding up quite strong. So this just adds to the challenge for the policymakers. So in this kind of an environment, to assume that there is rate cuts happening in anywhere in the foreseeable future looks a little I would say it's too soon to expect something like that. Yes, as we go ahead, I think Abhi briefly did allude to the liquidity conditions. So when we are talking about domestic liquidity, we are looking at next year's liquidity to tighten quite significantly. It is important, especially again when inflation is high, for RBI to ensure that liquidity is slightly on the tighter side. But the fact of the matter is that banks are having funding issues. There is tightness. And because of that, there will be a need for RBI to, at some point, step in through liquidity measures. They will have to step in. But again, that will come at a period when they have paused for some time, when they can really step in after that. So we do think structurally currency in circulation is going to cause drainage to the system. System liquidity is already tight, and from here is going to drain the liquidity further. And if there is no CRR cut, then the CRR product buildup in itself, because of NDTL growth, is going to be high. That will further add on to the liquidity. So I think liquidity will tighten quite significantly, and seasonally it tends to tighten much more in second half of the year. So that is the time somewhere during the middle of the year where I do associate a high probability of a CRR cut of 50 basis. Also, this would, given that the CRR is a more, I agree that, it could further worsen the inflationary problem. But I think at this point, when the banks are facing funding issues, it will be a much more homogeneous tool as against the OMO or anything to really provide the comfort. Also, it goes back to the pre-pandemic levels. The CRR rate was at 4%. So we have been talking about normalization of policy rates and everything to pre-pandemic levels. We still haven't seen the CRR back there. So my sense is we will see a repo rate hike of 25 basis for now, with a wait and watch mode for some time. And during the course of the middle of the year or so, I expect a 50 basis of CRR, purely because liquidity will be significantly tight. It will just worsen the situation. So to cap that kind of a worsening of liquidity situation, and to add to ease the pressure on the banks, there will be a CRR cut. If need be, there could be additional some amount of OMO purchases as well. But I think CRR cut, I would assign a higher probability. Yeah, I'd like to end here for now. Siddharth, over to you.
Thanks very much to Prasanna and all the previous esteemed panelists. I tend to agree with a lot of analysis and the insights that you all have brought in. Though recommendation in terms of the rates can be slightly different, and I'll try to explain where I'm coming from. We are in a particularly tricky situation at the moment. Last time when we discussed just before the February policy, the vast majority, not everyone here in the panel, but definitely the vast majority of the market consensus was in favor of one last hike in February, and we end there. From that point onwards, there had been 2-3 developments which actually took center stage. 2 data points on the Indian inflation front, where there was an upside surprise. There was some upside surprise in terms of global inflation number. At some point of time, Fed chair went out and guided the market in early March in terms of possibility of much more aggressive hikes on the part of the Fed in the coming months. But then there was a concern about the financial instability related issues that cropped up by the mid of March. However, what we have seen after that, after all these things and all the speculations about US and European banking system, what we have seen both US Fed as well as ECB stuck to their rate hike commitments and kind of indicated that they will be continuing with their rate hike projections, and in case of US Fed, the dot plot. In case of US Fed, now the interesting thing is, Indranil also mentioned about it in a way that very interestingly, we get to see that we talk about Fed funds, median Fed funds rate of 1 more hike. But importantly, another 6 people think that there will be 1 or 2 more hikes. At least 1 person think out of their 18-member list think there can be 3 more hikes even after that the hike that we are talking about in terms of our median scenario. Now, one strange situation that we are dealing with at this moment, that RBI is a flexible inflation follows a flexible inflation targeting framework. And when there has been, even though ideally we should be talking about inflation down the line, 2-3 quarters down the line, the last 1 or 2 inflation prints always have a very heavy weightage in terms of the thought process. Now, there we have seen 2 significantly higher or some bit of an uptick in case of the immediate inflation prints, which might have caused a lot of concern and possibility of upside in the RBI's reaction in terms of the repo rate. But what I would like to highlight here is that despite that, despite the hikes which we are talking about, or the upticks that we are talking about, we get to see that all the forecasts that we are dealing with, barring the El Nino related factors, and we'll get to see that how exactly the forecasts get changed over the course of the, at the time of the next MPC release. We are talking about inflation coming down by about at least about 100 basis points over the course of the next 2 to 3 quarters. And we are talking about a situation where the policy rate is not at something like 4% or 4.5% or 5%, rather it has come to 6.5%. We are talking about an EBLR regime where the pass-through is immediate and complete. And in that kind of a situation, we have already seen that, so we have spoken about this and it has been highlighted by all my previous speakers, but I think it's worth taking a note that a small-time home buyer who might have taken a loan at around 7% interest rate at some point of time about a year back now is paying the rate which is close to or will become close to 10% if there is another hike, and very significant. There is large number of instances of significant restructuring of their loan, in certain cases taking it to a significantly longer tenure of repayment, or significant uptick in their EMIs. If you don't do either of this, actually in every month after paying the EMI, your actual principal outstanding, even after paying the EMI, might actually go up mathematically. So to avoid that, we just do that. And that will be such a peculiar scenario that you are paying EMIs and after 1 year, 1 year down the line, your outstanding principal amount is actually higher than where you started the loan with. So I think we have to, now we are in a situation, it's understandable that there are multiple even though the RBI and the MPC may not be able to say that in so many words, that there is a concern in terms of keeping a margin or differential with the US Fed funds rate. There is a concern on the currency front. If it goes wrong, then it becomes very ugly. But at the same time, there are certain implications for the real economy, which possibly we cannot really put in the backseat anymore, given that large part of normalization of our repo rate has already taken place. It was much easier at a few months back when repo rate was significantly lower than our usual repo rate. Now we have to be a lot more careful. Otherwise, at some point of time, we might actually hit a tipping point, in my view, for so far as the implications for the real economy, so far as the implications for certain vulnerable sections of the economy is concerned. And that might actually be a significantly high risk. It's true that so far we have maintained some kind of a, loosely speaking, kind of oversimplification. We have maintained some kind of a thumb rule of 2:1 kind of a response vis-a-vis the US Fed. But there is a genuine risk of if we see a scenario of US Fed going significantly beyond what is the median Fed funds projection at this moment, we might have to think twice about what exactly we do. But at this moment, given the way we have delivered the repo rate hikes of 250 basis points within a short span of time, and this is the first time we are dealing with the EBLR regime, I think we need to be slightly more cautious in terms of delivering further hike at this moment. If there are more risks 3-4 months down the line, we might have to revisit this particular issue. And another one particular issue I think is it'll not be fair if I mean, I would like to highlight it this way, that in case if we get to see our inflation projections are going up because of weather-related concerns and because of the El Nino forecast or suboptimal monsoon scenario, if inflation forecasts go up just because of that, what should be the reaction of the RBI? Should we still go strictly by a number-driven phenomena that, okay, my inflation is going up by about 30-40 basis points, so I'll just go for the response in terms of repo rate? Or we take a more balanced view about what exactly happens to the economy, both in terms of its implication on the growth scenario and people's distress and all this thing, take into account all these factors. So overall, my sense is that we have done quite a lot in terms of repo rate hike. I do believe that in most countries, after this round of rate hikes, there will be a phase of significantly long pause, potentially longer in case of India rather than in some of the Western economies. So we should take rates to a level where we can actually be okay to keep it there for a significantly long period of time, rather than thinking about a response where we are hiking it very aggressively at this moment and building up a pressure on ourselves in terms of towards cutting the rates sometime as early as in 2-3 quarters. I'll stop here and would be happy to pass on to Dr. Charan Singh or Dr. Bhalla if he is back.
Dr. Bhalla, can we have your views?
Yeah, thank you, Charan. You know, I think Siddharth has saved me, because my opening comments were going to be that unfortunately I happen to disagree with all of the people who have spoken before. So now I don't have to say that I disagree with all, but I disagree with all but one. I also want to give a caveat, or, you know, I have the luxury, which none of you have, of not being accountable for being right or wrong about the forecast of what the RBI would do. And that, you know, having been in the markets, etc., I fully appreciate that you have to appeal to a very different audience than economists per se. You are judged by how rightly you predict what the RBI does, and in the US, you are judged by how rightly the Fed does. Now, nobody asks And none of the, actually, one of the amazing things that I found out, that having been in the US for a long time and now recently for 3 years, is that, you know, you will question, or an American, in America, you will question anybody and everybody on everything except the Fed. Why? And sometimes we should have a meeting. I'm serious. Why is it that the Fed is a holy cow? That they can't do anything wrong, and that you're putting yourself in an embarrassing situation by disagreeing with the Fed. And I think the same story transfers over to, let me just turn on the lights here one second. Yeah, and I think the same story transfers over here, that, you know, far be it for anybody to question the RBI. That's why I think Siddharth is a brave man, a brave person, a brave economist, and he is in a bank. I would be worried. But, you know, I think we have to be, especially in the Shadow Monetary Policy Committee, we can be a bit freer in terms of our analysis. And, you know, I may be completely wrong. So it's not the forecast for me that matters. Though as I said, I fully admit to the reality that the forecast for all you market participants really matters. So after that apology of a caveat, let me proceed. You know, we have to ask ourselves as to how much does monetary policy have to do with inflation, and how much does monetary policy have to do with growth? Now, I belong in the camp that there's considerable empirical evidence that monetary policy, that is real interest rates, real Fed funds rate or real policy rates actually do affect growth. Okay, so in other words, I don't think monetary policy for growth is irrelevant. It's very irrelevant. But I do think we all need to begin to ask whether monetary policy is really relevant in today's day and world for inflation. Second, is monetary policy, somebody, I think, Charan, you had mentioned, you know, inflation in some country X was 30 times the average of whatever it was, right? For 20 years, make it 30 years. It's 30 times the average for 30 years. Look, what is inflation being caused by now in the world? It is caused by supply shocks. So in other words, did the world ever have the madness of a COVID lockdown in practically all the countries of the world? Did the last 30 years ever had the madness of this war going on, especially for Europe? So I think such references we should keep out. It has no meaning in my view, and doesn't help us to understand what policy making should be or is. Now let's turn, so I think, forget the past. Now let's look at what is happening in Europe and what's happening in the US. And I'm doing Europe and the US because all of us seem to follow the Fed or follow the ECB and not look at the particular situation. And again, I think Siddharth was very particular about the domestic situation, Indian situation, but most of the others were not. Let's look at, so the European inflation is clearly, you know, a lot affected by energy, gas prices, what have you, the war, okay? Now, in the US, I would encourage all of you to look at the following. Look at the CPI seasonally adjusted for the last 9 months since July. What you would find is in the US, the great land of the Fed, in the US, the seasonally adjusted average rate for the last 8 months, July 6th, 7, 8 months has been, is average less than 3.5%. Less than 3.5%. Now, does that warrant that you go ahead and raise rates? I mean, the overall average for the US is about 2.5%. And for the last 8 months, it's 3.5%. So why are we raising rates? What relationship will this have with anything to do with the price? And plus, you're causing, and we know they have caused, by their, what I would say, unthinking policy, that they have caused financial troubles, banking crisis. Now, the banking crisis occurs, then obviously we can blame, or it's mark to market, or it's this, or it's that. When in the history have we seen such a remarkable rise in real policy rates? Never before. Remember, real policy rates, not nominal rates, which happened during the Volcker time period, because inflation was very high. You've got this remarkable rise in real policy rates, and then we have Fed officials, bankers, chief economists all saying, oh my God, these bankers don't know banking. And therefore this problem is upon us. If only they knew banking, we wouldn't have any problems. So I really, I think the world has gone wrong. I think the policymakers have gone wrong. I think we have gone wrong. Because I don't know if you saw this piece, what the RBI has done is what we have been doing for the last 30, 40 years, and I've been writing that in public, so I don't mind saying that. In India, we have a real shock, supply shock, droughts. And what's the first response of the RBI? Let's raise rates because inflation has gone up, without looking at what has caused the inflation to raise rates. And then when we have nothing better to do, we say, oh, we are anchoring expectations. So my plea is we should, it's a very different world than certainly what I grew up in. And I guess some of you also. At that time, the world was becoming globalized. There were a lot of uncertainties in the world. Now, what is the uncertainty in the world? And supply is global, is not domestic. Demand is global, not domestic, though we have a luxury more than other countries because we are a large economy. So I think, I wouldn't be surprised if they hiked rates, if the RBI does, but I think it'd be yet another mistake. I think definitely I'm the camp that says that there isn't reasonable justification for raising rates now. And, and then I also don't understand my last bit. Okay, the US will raise rates now and raise rates the next time, and then we'll cut rates. What have you got? If you raise 50 basis points over the next 3 months, 25 has already been done, 25 will do, and then you cut 50 basis points. Can somebody please explain how that accounts for behavior, how that accounts for reduction in inflation, how that accounts for inflation expectations? How does a policy rate increase now of 50 basis points followed by, and that's what the Fed Fund futures are showed, they're followed by 50, 75 basis points cut the rest of the year. So look, I don't understand. Let me just put it this way. I do not understand the logic behind what the Fed is doing, what a lot of the economists in the US are saying, as well as this forecast of the dot plots. Okay, we'll raise rates now, and then we'll lower rates by an equal amount, all in the space of 6 months. So I'll stop there. I don't understand what's going on. Thanks.
Arjun?
Professor. Thanks a lot. I'll just keep it a bit brief. I'll start off with, again, a comment of mine that I feel inflation targeting in India does bring about some credibility, but times like these does a lot of disservice to a country that's still fairly not as financialized as inflation targeting the developed economy. Now, coming to the RBI's rate, I think mid of last year, our stance has been that the RBI will take the repo to 6.5 and stay there and keep it at 6.5 for almost all of FY24. That has been our base case. There has been a lot that has happened over the last few weeks, rather a month and a half. I don't really think that is going to change anything for the RBI. Like always, there are two things. One is what the RBI should do and what the RBI will do. What the RBI should do is probably should have stopped the rate hike cycle well a month and a half ahead. But given that they did deliver a 25 basis points in the last policy, they are now at 50% of what the Federal Reserve has done. So in 12 months, the Federal Reserve has done 500 basis points. The RBI has done 250 basis points. And the March rate hike from the Fed is already priced in the RBI 6.5. Now, the rate hike that we have seen from the RBI of 250 basis points, in my view, is largely to do with the Fed, has not, though the narrative is inflation from the RBI standpoint, the real narrative remains Fed and will remain Fed. From a Fed point of view, our base case was that if the Fed fund rate crosses 575, 550, 575 range, then there is another very high possibility of another 25 basis points rate hike from the RBI. But given that that has not taken place and the Fed is expected to sort of raise rates by another 25 basis points, taking it to 525, our base case still is that 625, it will be a pause in April, and this pause will continue all through FY24 till the end of the fiscal year. Now, two more things and then I'll stop. On the RBI, from the RBI standpoint, I think a lot of things have changed. One is the banking crisis that you've seen in the US. The response to that has been very clear from Powell. So he's been talking about how inflation from a level point of view, year-on-year inflation is going to come down. Probably will be sub 3% by August, September. But the absolute levels are still a point that they want to be concerned about into FY24. So rates are not going to be cut like the Fed fund futures. Fed fund futures, in my opinion, sort of work at inflection points at extremes. But since June, July of 2022, the Fed fund futures have been consistently wrong, and they have actually tagged the Fed, tagged Powell's comment and Powell's language, and I think that will continue. So as of early Jan of this year, the Fed fund futures were actually in 2023. Now the cuts are back on. Another 25 basis points rate hike and then a 50 to 75 basis points cut soon after. I don't think that's going to take place. Our base case is that the Fed will do another 125 basis points, take it to 525, stay at 525 for most of 2023. And as a result, the RBI also does the same thing. The cumulative rate hikes of 250 basis points by the RBI and the 500 basis points by the Fed, we have still not seen it weigh down on activity as yet, both in the US and in India. And for that reason, I think it was the most appropriate response. On the banking crisis issue, I think they've sort of sorted it out. The contagion fear is completely out of the window. You've seen the Fed in nearly a week and a half raise its balance sheet by more than $300 billion. So I don't think there has been a time in the past where the Fed's hiking and at the same time doing something quite the opposite, raising the balance sheet up. So quantitative tightening is literally dead, at least for the next 12 months. So from that framework that we're looking at, from an India-specific point of view, I think Dr. Charan Singh alluded to this about crude. I think that's a very significant point, and that's what we've also been talking about internally, about how from November of 2022, from nearly $100 a barrel, crude is just above 70. What it does is it gives more comfort to the rupee. The financing pressures on the rupee are much, much lower now. And from an RBI point of view, given that there has been a very clear tagging the Fed and protecting the rupee narrative from the RBI, not as explicitly though the underlying I feel is that there's much more wiggle room for the RBI to not do anything on the rates and can be sort of asynchronous from global policy. They can sort of afford to, given that the trade deficit has come down to around 17 billion run rate, closer to the 10-15 billion that it saw pre-COVID. So reasons, I think a pause in April and a pause till the end of FY24, unless, of course, there are disruptive global growth related issues that one will be experiencing over the next few quarters. Yeah, that's it from my side.
Thank you. Thank you, Arjun. Can we go now over to Mr. Sadaf Syed, CEO Muthoot Micro? And I would request you to be brief and focused.
Yeah, thank you very much, Dr. Sharan Singh. Good afternoon, everyone. I think I've heard all the eminent economists and their point of view, and I agree with most of them. I will share my point of view, but I think following this act is difficult, so gustakhi maaf pehle hi. But I would like to mention the point of view from a microfinance lender and catering to the household at the bottom of the pyramid. So basically, yes, definitely a rate hike has an impact on the EMI and consequently on the household budget. But most importantly, I think the household budget is more impacted by the all pervasive inflation. Typically a rural household, which we are talking about a 3 lakh rupee per annum income or 25,000 rupee per month kind of an income household. And if the inflation continues to persist where it is today, it has an impact on the behavior of the household where unlike a kind of a middle income or a higher income household where discretionary or a luxury kind of an item gets compromised, here the essentials get compromised, which affects the nutrition of the household. And ultimately, like discretionary spending, as in the household might cut on consumption of some milk, some essential food items, which will definitely have on the nutrition aspect. And then it has an impact on the health of the household and the productivity household. So from a point of view of a sector which is focusing at the bottom of the pyramid, we expect that RBI should definitely counter inflation. I think the projected growth rate is in the range of 5.5% to 6% for the next financial year, and the current year itself, the growth is around 6.9% and thereabouts. So I think India will continue to be a economy which is still going at a good rate. So a hike of a 25 basis point from a point of view of tackling inflation at the moment is more important than the impact of a 25 bips hike, which will have on the borrowing or in the loan installments of the household. So that's my submission.
All right. Thank you very much. We have had a wide range of thoughts. I totally agree with the wide range because at the end of the day, we are providing inputs to the RBI and it's good that they get to see and listen to various thoughts. I just want to clarify, despite all the hikes in the interest rates that have taken place in the US, inflation, and they're almost a year, inflation has just come down from 10% to 6%. It's still around 6%. So therefore, what Dr. Bhalla is saying, is there a relationship? I'm not very sure. And when it is obvious it's a supply side story, then it's so obvious that this needs to be examined further rather than use a sledgehammer or give the confidence that the RBI is doing something, whereas everybody knows that it can hardly do anything when a supply side story is playing such a prominent role. So I think that's the point which I was trying to also make and which Dr. Bhalla has made more forcefully. Despite all the efforts done, even at the Euro, even in the UK, inflation continues to be much higher than their tolerance levels or their 2% to range of 2%. And the point that I was actually making, maybe I didn't articulate it well, that if I take even a long-term average on the basis of which the tolerance bands are determined, despite aggressive interest rate hikes, those rates have not been achieved in a year. Then the question arises, what is the transmission cycle and what is the period of transmission? Is it 2 years? It is 1 year. If it is 1 year or 2 years, then obviously the question that comes next is, on what basis are the American economists predicting a hike in the interest rates soon after? So the transmission cycle would totally go crazy in case we have followed one pattern to tame inflation and then suddenly started lowering the interest rates. Then what happens to the transmission cycle? So I think there seems to be need for far more research, and I think, and this is important, that if inflation is because of the supply side and not the demand side, is the interest rate the right instrument to fight that inflation? That's exactly the point that I was trying to make. I think Dr. Bhalla has made, and that's exactly the point which Siddharth made, that if inflation is going to be high because of a bad monsoon due to El Nino, will we still persist with the interest rate hikes, or will we have to find other ways to address? So I think the source of inflation becomes very important. With this, I would like to, in case anyone else wants to come in, I understand Indranil had to leave for a meeting, Upasana had to leave for a meeting, Abhik and Siddharth, do you have second round of thoughts to share? Dr. Bhalla, would you have any more thoughts to share? Okay, then let me
Dr. Charan Singh,
yeah.
This is Prithviraj. I mean, can participants, put out a thought or a question?
Yes, please, but be very brief. We are already 13 minutes above the time. Be very brief.
Sure. I'll be super brief. I'll be super brief. This is basically, responding in a way to what Dr. Balla mentioned, right? I mean, if you look at core inflation in India, it's been running. It's running elevated even in seasonally adjusted terms. If you annualize it, the run rate is about 6%, and to a large extent, to my mind, it's basically households, basically the top end of the income households, who have accepted high prices, and you can see this reflected in company earnings and company profitability. So you've seen input prices come off. Now, at this juncture, if we do not restrain demand through appropriate interest rate increases, my sense is that we are not sending the right signal to businesses and to the economic agents to actually pass on some of these input cost declines on to consumers, right? So from that angle, I would still say that maybe it's probably prudent to continue with a few more rate hikes to ensure that you see this pass through of input cost inflation. So I'll throw this out there, and this is also sort of in light of what Christine Lagarde at ECB mentioned, that where they have a concern that firms are trying to increase their profit margins to protect themselves from inflation, and labor is trying to demand more wages to protect themselves from inflation. So maybe we don't want to get to that stage, and it's appropriate for RBI to sort of take that step right now with the rate hike. I'll stop here.
Okay, thank you very much. But that's exactly the point which some of us have been making, saying that is there a relationship in the interest rate hikes and taming inflation if inflation is not demand related? That's exactly the point. That's exactly the point which Surjit Bhalla made so forcefully, saying that if it is the war, or if it is the geopolitics, or the supply side disruptions which are causing the inflation, how much of interest rate hike will tame inflation? As you have seen, and as I mentioned it repeatedly, that despite aggressive interest rate hikes, inflation in advanced countries, Euro, UK, America, has not been tamed or brought to the level that is of their comfort or convenience. So the instrument of interest rate, is it effective? That's the point that is being discussed. If not, can it hit growth badly? That is the other concern. On India, there's a lot has been said. I would like you to refer, and I think part of the discussion relevant here, what is the threshold level of inflation? Is the 4% right to be the pivot of the inflation targeting? those issues need to be discussed. Excellent work done by Professor Dholakia, who was a member of the MPC earlier, that the threshold level of inflation in India is around 5%. And if you try to target inflation below 5%, you will cause sacrifice ratio. I think more research.
Sir, if you kindly permit, I just wanted to highlight one particular point. Often, my sense is that, and apologies if I mean it's too harsh, but many times it so feels that a large, I mean, we are all getting carried away by our projections for the next monetary policy and always remaining very, very incremental in terms of our forecasts. That what is going to happen in the April policy, then in the June policy, etc. And given the way inflation is staying, just looking at the inflation number, and if you just want to be having a knee-jerk reaction to an inflation print, then you have to continue hiking. I don't know for how many more quarters. So it's much more. It's very, very important, at least, to take into account a more holistic picture that on the interest rate trajectory where we stand today. So my reaction with the same inflation rate, if my repo rate is at 4% and my repo rate at 6.5%, can be very different. I think that particular discussion needs to come at the center stage, which I expect to happen at this juncture. The other point which I want to mention, that we all are making things, I mean, in many cases, we are seeing some kind of an simplistic interpretation that if I hike interest rates, inflation will come down, which is a huge question mark in case of India. You mentioned in the case of US, I would say that we need to see proper empirical evidence to what extent interest rate sensitivity in case of CPI, headline CPI inflation stays there, I mean, exists in case of India. And the last point here is, we are making simplistic interpretations that US this cycle will be going up to for one more hike. But it's very important to note that out of the 18 Fed presidents, 10 are talking about one more hike, and 7 are talking about, 3 are talking about 2 more hikes, 3 more are talking about 3 more hikes, and 1 is talking about 4 more hikes from here on. So my sense is that we cannot take that just one more hike will be there. And given that Fed will be doing one more right now, I do one more and I am done. Fed is done, I am done. I don't know. So the thing is that this is time to look more into the domestic factors, stay guided more by the domestic factors, where the impact on growth can actually be significantly more and direct rather than impact on the inflation front. So there is logic to say that we stop here. But if at all, at some point of time, we figure out that Fed is on the way for another three more hikes, then possibly I have to take a call, do some kind of a, if I call it a cut loss on my decision. At some point of time, I have to do more hikes. I may come back and end up doing more hike. If at that point of time, saving the currency, maintaining the differential becomes more important. But just thinking that Fed will be doing just precisely one more hike and I'll be absolutely fine with just precisely one more hike might be a little misplaced.
I think we should close our discussion now. We've gone nearly 20 minutes above our time. Back to Dr. Rajesh. I think we have said, all of us have said enough, and I think that should provide good inputs to the RBI monetary policy, which we'll share with them. So back to Dr. Rajesh.
Thank you, sir. Vasudev, sir, would like to add anything, sir?
Yes, I just wanted to thank Dr. Singh, Dr. Bhalla, and our esteemed panelists, as well as the participants, for this very enlightening discussion. As Dr. Singh mentioned, we're going to be putting all this together, and we will be taking this up with the RBI and providing inputs for the upcoming monetary policy. So thank you all once again for this very enlightening discussion, and we look forward to having you all with us again in the next cycle. Thank you.
Thank you. Thank you so much, sir. Thank you to all for your kind presence. Thank you, sir.